$121.67. That was silver's price on January 29th of this year. Write that number down because it is the most important number in this entire video. Because today, right now, silver is sitting at $73. That means silver has fallen 40% from its all-time high in just a few months, 40%. And if you are a silver holder looking at that number and feeling confused, frustrated, or genuinely uncertain about what is happening and why this video is specifically for you, because the story behind silver's collapse from $121 to $73 is not the story most people are telling. It is not a story about silver being wrong. It is not a story about the bull market being over. It is a story about a very specific set of forces that created a very specific kind of price suppression forces that are temporary, identifiable, and already beginning to reverse. And when you understand exactly what happened, exactly why it happened, and exactly what the data says comes next, the picture that emerges on the other side of this decline is one of the most compelling setups in the silver market's modern history. Stay with me because this one matters more than almost anything else you will watch today. Let's start at the beginning, January 29th, because understanding what drove silver to $121 in the first place is essential for understanding why the subsequent decline happened and why it does not invalidate the structural thesis. Silver did not reach $121 because of speculation alone. It did not reach $121 because retail investors got excited and piled in. It reached $121 because every single structural force driving precious metals was firing simultaneously at maximum intensity. The gold-silver ratio had compressed dramatically, real interest rates were in deeply negative territory. The Federal Reserve was in an active easing cycle with rate cuts already delivered. Physical silver demand from solar manufacturers, EV producers, and AI infrastructure build-out was running at record levels. The COMEX registered inventory situation was already showing stress. The World Silver Survey had documented a fifth consecutive annual supply deficit. Central banks were buying gold at multi-decade record pace, and the ratio signal was pointing silver toward dramatic outperformance. All of those forces were real, all of them were documented, all of them were driving genuine institutional and retail demand that pushed silver to a level the market had never seen before in nominal terms. The $121 high was not a bubble built on nothing. It was the price discovery of a market where every legitimate structural driver was aligned and fully activated simultaneously. That matters enormously for understanding what comes next. Please hit that like button right now and subscribe to this channel because this is the kind of connected, honest, data-driven silver analysis that this community gets every single week, and we want you here for every video. Now let's talk about what happened between January 29th and today, because the 40% decline from $121 to $73 has a specific cause that is both identifiable and critically temporary. The single most important catalyst for silver's collapse was something that had nothing to do with silver's fundamentals. It was the nomination of Kevin Warsh as the next Federal Reserve Chair. On January 30th, one day after silver's all-time high, President Trump announced that Warsh would replace Jerome Powell, and the market's immediate reaction was violent and specific. Silver fell 31.4% on that single day, its worst single session since March 1980. Gold fell 9%. Why? Because Kevin Warsh is known as a monetary hawk. He was a Fed governor from 2006 to 2011. He emerged from that era as a critic of the Fed's loose monetary policy, and his reputation for prioritizing inflation control over growth stimulus told the market one thing with crystal clarity: the easing cycle that had been fueling precious metals was potentially over, or at minimum, about to become significantly less aggressive than previously expected. The opportunity cost of holding non-yielding silver suddenly looked much higher if Warsh was going to keep rates elevated or potentially raise them further. The crowded speculative long position in silver, built on the assumption of continued Fed easing, unwound with catastrophic speed, and 40% of silver's price evaporated in a matter of weeks as that unwinding ran its course. But here is what makes this decline so analytically interesting and so important to understand correctly. The Warsh shock was a monetary policy signal shock, not a fundamental silver supply and demand shock. Every single structural driver that pushed silver to $121 remained completely intact the day after the Warsh announcement. The supply deficits did not disappear. The industrial demand from solar and EVs and AI did not slow. The COMEX registered inventory situation did not resolve. The gold-silver ratio did not permanently reset to a level that precludes future compression. None of the physical market dynamics that constituted the bull case for silver changed because of who Trump nominated to run the Federal Reserve. What changed was the market's assessment of the monetary policy timeline, specifically how quickly real interest rates would fall from restrictive to accommodative territory. That is a timing change, not a structural change, and timing changes, while they can produce violent short-term price movements in a market as volatile as silver, do not invalidate structural theses. They delay them, and delayed structural theses, when they eventually resolve, tend to resolve with more force than originally anticipated because the fundamental supply and demand imbalances have had more time to compound while the price was suppressed. Let's add the Iran conflict dimension to this story, because it is the second major force that has been pressing silver lower from a completely different direction, and understanding it is essential for the complete picture. The US-Iran war, which began in late February and has now been ongoing for 10 weeks, created what financial Analysts are calling a paradox in precious metals markets. On the surface, a major Middle East military conflict should be bullish for gold and silver as safe haven assets, and initially it was, but the mechanism through which the Iran conflict has ultimately pressured silver is more complex than the simple safe haven logic. The effective closure of the Strait of Hormuz sent crude oil prices surging. Surging oil prices fed directly into inflation expectations. Elevated inflation expectations pushed Treasury yields higher into the 4.3 to 4.4% range. A stronger inflation narrative reinforced the hawkish case for keeping rates high or potentially raising them, and all of that higher yields, stronger dollar, diminished rate cut prospects is a triple headwind for silver simultaneously. The very same geopolitical event that should have been driving silver higher through safe haven demand was instead driving silver lower through the monetary policy channel. That is the paradox. And it is precisely the kind of complex multi-channel macro dynamic that shakes out investors who bought silver on simple narratives without understanding the full transmission mechanism. The investors who understood the paradox, who recognized that the Iran conflict was temporarily suppressing silver through the inflation rate dollar channel while simultaneously building the structural case for silver's eventual recovery. Those are the investors who held rather than sold into the panic. Now let's talk about what the data actually looks like right now beneath the surface of the $73 price, because the fundamental picture that exists today is not weaker than it was at $121. In several measurable ways it is stronger. The World Silver Survey 2026 published just weeks ago confirmed a projected sixth consecutive annual supply deficit of 46.3 million ounces for 2026. The 2025 actual deficit was 40.3 million ounces. Since 2021, approximately 762 million ounces have been drawn from above-ground silver stocks to cover the cumulative deficit, 762 million ounces of above-ground silver inventory consumed in 5 years to bridge the gap between what mines produce and what the world demands. That is not a number that gets smaller because of who chairs the Federal Reserve. That is a structural physical reality that compounds with every passing month regardless of monetary policy. The COMEX registered silver inventory coverage ratio, the ratio of physical silver available for delivery against total outstanding paper contracts, sits at approximately 13.4%. That means for every 1 ounce of silver available for delivery, there are roughly 7.5 ounces of paper claims outstanding. That ratio has been below what analysts identify as the stress threshold for 6 consecutive reporting periods. It did not improve during the price decline. If anything, the physical tightness has intensified as lower prices incentivize industrial users to accelerate purchases while reducing the incentive for mine operators to expand production. Here is a data point that almost nobody is talking about, but that every serious silver investor should have front and center in their analytical framework right now. China's silver imports in the first 2 months of 2026 reached 206.76 tons, the highest level in 8 years, while the paper silver price was being crushed by war shock and Iran war paradox dynamics. Chinese industrial and investment buyers were importing physical silver at a pace not seen in almost a decade. That divergence, paper price going down while physical import demand is going to multi-year highs, is one of the most powerful signals available in any commodity market. It tells you that the entities with the most direct knowledge of physical silver's real-world scarcity value, the industrial users and strategic buyers who need actual metal rather than paper exposure, are using the paper price weakness as a buying opportunity rather than a signal to reduce their exposure. They are buying more silver at $73 than they were buying at prices significantly lower just a few years ago. That behavior from the world's largest silver-consuming nation is the physical market speaking more honestly about silver's real value than any futures price managed by financial market dynamics. Let's also address the AI infrastructure demand story specifically, because it has emerged as a silver demand driver that was not fully priced into the $121 high and is becoming more significant with every passing month. The 4 largest AI hyperscalers, Google, Amazon, Microsoft, and Meta, have announced combined infrastructure spending plans of $725 billion for 2026 alone. That is up 77% from last year's $410 billion. Every data center in that build-out requires silver in electrical connections, in thermal management systems, in high-frequency circuit boards, in the power distribution infrastructure that keeps those facilities running. And unlike solar demand, which the World Silver Survey 2026 actually noted is falling slightly as manufacturers reduce silver content per panel through efficiency improvements, AI data center demand is growing with no sign of reduction. It is contracted, it is locked in, it does not slow in recessions, it does not respond to silver's price the way discretionary demand does. The hyperscalers are building because they have to build, and every building they construct consumes silver. That demand is arriving into a physical silver market that is already running a 46 million ounce annual deficit. It is additive pressure on a system that was already under stress. And at $73 silver, none of that AI demand pressure is remotely reflected in the price. Now let's address the Kevin Warsh question directly and honestly, because it is the elephant in the room for every silver bull right now, and pretending it is not a complicating factor would be intellectually dishonest. Warsh's full Senate confirmation vote is expected the week of May 11th, 6 days from now in Powell's term. Ends May 15th. The transition is happening. The question for silver investors is whether Warsh's actual policy behavior will match the hawkish reputation that triggered the January sell-off. And here is what the data and the reporting actually say about that question. Warsh has been publicly critical of the Fed's use of official core PCE at 3.0% as its primary inflation measure, preferring instead the Dallas Fed's trimmed mean PCE, which currently sits at 2.3%. That 0.7 percentage point difference is not academic. If Warsh uses the trimmed mean as his primary inflation gauge rather than core PCE, the Fed's real rate calculation changes. Significantly, it becomes less restrictive than it appears under the official measure, which means the argument for rate cuts becomes stronger sooner than the market currently prices. Additionally, Trump has publicly stated he would be disappointed if Warsh does not cut rates in June. The political pressure on Warsh to be accommodative is real and documented. The picture of Warsh as an unambiguous hawk who will indefinitely delay rate cuts is considerably more complicated than the January sell-off suggested, and markets that overprice a hawkish Warsh in January have a long history of correcting that overpricing when the actual policy behavior proves more nuanced than the initial panic suggested. Here is the complete picture that emerges when you put all of these pieces together: the $121 high, the $73 low, the structural data beneath the surface, the Warsh dynamics, the China import surge, the AI demand build-out, the sixth consecutive deficit, the 13.4% COMEX coverage ratio, and the Iran conflict. Paradox: silver fell 40%, not because it was fundamentally wrong at $121. It fell 40% because two simultaneous monetary shocks, the Warsh nomination and the inflation rate channel of the Iran conflict, hit an extremely crowded speculative long position in a thin market at the same moment. The speculative excess was real and the correction was warranted, but the structural thesis that drove silver to $121 in the first place not only survived the correction, it strengthened during it. 662 million ounces of cumulative deficit, 13.4% COMEX coverage, Chinese physical imports at 8-year highs. AI data center silver demand accelerating, mine supply flat despite 42% higher average prices in 2025, a U.S. regulator publicly endorsing legislation that acknowledges the silver market's structural problems, and a new Fed chair who, whatever his hawkish reputation, faces both political pressure from Trump and a more favorable inflation measurement framework than his predecessor. The setup that exists at $73 silver today is a structural bull case sitting at a 40% discount to the price that same structural bull case produced just 3 months ago. That is not a story of defeat. That is a story of an extraordinary entry point for investors who understand what actually happened and why. What comes next is not a straight line higher. Silver never moves in straight lines. The volatility that produced a 40% decline in 3 months is the same volatility that can produce dramatic rallies. The specific catalysts that will drive silver's recovery are identifiable and time-sensitive: the Warsh confirmation and his actual policy tone, any progress towards Strait of Hormuz resolution that removes the inflation through energy headwind, the May COMEX delivery cycle playing out against the 13.4% coverage ratio, the next round of physical demand data from China, and the ongoing AI infrastructure capex that keeps adding industrial demand into a deficit market. Each of these catalysts has a near-term timeline measured in weeks and months rather than years, and as they resolve, as the paradox of the Iran conflict unwinds, as Warsh's actual policy proves more nuanced than January's panic priced in, as the physical deficit continues to compound, the market will be forced to reprice silver toward the levels that the structural reality actually supports. The question is not whether that repricing happens. Based on 5 decades of silver market history and the current fundamental data, it is a question of when, and at $73, 40% below the price that structural reality produced just 90 days ago, the when may be closer than most people sitting on the sidelines are willing to admit. Leave a comment right now and tell us, did you hold your silver position through the 40% decline from $121, or did the war shock and Iran war dynamics shake you out? We genuinely want to know how this community navigated one of the most violent silver corrections in recent memory, because your experience shapes the analysis we build and the conversations we have. And if you know a silver investor who sold during the panic, someone who watched silver fall from $121 to $73 and concluded the bull market was over without understanding what actually caused the decline, share this video with them right now, because the difference between understanding a correction and being broken by one is the difference between being positioned for the recovery and watching it from the sidelines. We will see you in the next one.